Hey everyone, welcome back to the channel. Today we will do a complete deep dive into my dividend portfolio. We're talking about a $25,000 portfolio spread across 8 different stocks, and I'm going to break down everything. The yields, the growth potential, the sustainability, and most importantly, whether this strategy is actually working. If you're interested in dividend investing, whether you're just starting out or looking to optimize your current portfolio, this video is going to give you a real-world case study with actual numbers, real data, and honest analysis. We'll cover everything from basic yield analysis to advanced metrics like payout ratios and yield on cost. So first, let me give you the big picture of what we're working with. This portfolio is built around 2 main categories of stocks. The first category is what I call growth stocks. These are companies like Nvidia, Meta, Salesforce, Microsoft. These companies traditionally haven't been known for their dividends, but recently they have started paying dividends, because it is getting harder and harder to grow the core business, so nevertheless we're going to include them for this purpose. These growth stocks make up about 84% of my portfolio value and are more of a growth play, not a dividend one. They typically pay very low current yields. We're talking about yields between 0.02% and 0.74%. The second category is what I call dividend plays. This includes UOB, which is a Singapore bank, and DEVL, which is also a Singapore bank. These make up about 16% of my portfolio, but they're doing the heavy lifting when it comes to current income. UOB yields 3.2% and DEVL yields 5.36%. This two-pronged approach gives me the best of both worlds: current income from the dividend plays and massive future income potential from the growth stocks as their dividend programs mature. Let's break down the actual numbers. The total portfolio value is around 25k and is generating 267.06 euros in annual dividends for a portfolio yield of 1.05%. I know what some of you are thinking: 1.05%? That's terrible. But hold on, because this doesn't tell the whole picture. Looking at the allocation, you can see that growth stocks represent 21k of the portfolio, that's 84.1%. The dividend plays represent the portfolio 4k, that's 15.9%. But here's where it gets fascinating. Despite being only 15.9% of the portfolio value, the dividend plays generate 62.5% of the total dividend income. So the current yield is being suppressed by the large allocation to low-yielding growth stocks. The annual yield of 1.05% might seem low compared to a traditional dividend portfolio, but remember, we're not just investing for today's income. We're positioning for tomorrow's income growth. Let's dive deeper into the dividend income breakdown. The total annual dividend income is 267.06 from our 25k portfolio. When we look at the individual contributors, DEVL is the clear winner, generating 137 annually with its 5.36% yield. UOB follows at 3.2%. Together, these two stocks, representing just 15.9% of the portfolio, generate about 62.5% of the total income. The growth stocks, despite representing 84% of the portfolio value, currently contribute only about 37.5% of the dividend income. SPGI leads this group, followed by Microsoft. But here's the key insight: this imbalance isn't a bug, it's a feature. The growth stocks are in the early stages of their dividend journeys. As these companies continue to grow their earnings and mature their dividend programs, this income distribution will shift dramatically. The current portfolio yield of 1.05% is just the starting point. The real story is in the growth potential, which we'll explore in the next section. This slide really drives home the strategic nature of this portfolio. We're comparing the allocation percentage versus the dividend contribution percentage, and the contrast is striking. High-yield stocks, UOB and DEVL, represent only 15.9% of the portfolio allocation but generate 62.5% of the dividend income. Meanwhile, low-yield stocks represent 84.1% of the allocation but only 37.5% of the income. This might seem inefficient at first glance, but it's actually a calculated trade-off. I'm accepting lower current income in exchange for higher future income potential. The growth stocks have the potential to multiply their valuations and dividends over the next 5 to 10 years, while the dividend plays are more likely to provide steady, modest growth. Think of it this way: the dividend plays are my income foundation. They provide the cash flow I can count on today. The growth stocks are my income growth engine. They're building the cash flow I'll enjoy in the future. This strategy requires patience and a long-term perspective, but the potential rewards are significant. As we'll see in the dividend growth analysis, some of these growth stocks have the potential to increase their dividends by 10% or more annually. Now let's talk about one of my favorite metrics: yield on cost. This shows you what your effective yield is based on what you originally paid for the stock, not the current market price. The results here are really encouraging. My average current yield is 1.42%, but my yield on cost is 1.79%. That's a 26% advantage thanks to capital appreciation. The standout performer is DEVL. I bought it at 23.67 and it's now trading at 32.93. That 39% price appreciation means my yield on cost is 7.46% compared to the current yield of 5.36%. That's an extra 2.10 percentage points of yield advantage. UOB is also performing well, with a yield on cost of 3.95% versus a current yield of 3.2%, thanks to 23% price appreciation. Even some of the growth stocks are showing positive yield on cost advantages. SPGI, MSF, and others have appreciated enough to boost my effective yield. The only underperformer is FOO, Salesforce, which has declined 15% since I bought it, reducing my yield on cost to 0.53% versus the current 0.63%. This metric is crucial because it shows that a good dividend growth strategy isn't just about the dividends, it's about total return. The combination of dividend growth and capital appreciation creates a compounding effect that can be incredibly powerful over time. This is where the strategy really comes together. Let's look at the expected dividend growth rates for each stock. The leaders in dividend growth are actually the dividend plays, UOB at 13% expected growth and DEVL at 12.9%. This might surprise some people who think of banks as slow growth sectors, but these are quality companies with strong fundamentals. Among the growth stocks, SPGI leads with 12% expected growth, followed by MSF at 10.2%. The tech stocks NVD, FB2AD, FOO, and ABEC are all clustered around the sector average of 9.22%. Now, these growth rates might seem modest compared to some high-flying growth stocks, but remember, we're talking about dividend growth, not stock price growth. A 10% annual dividend growth rate means your income doubles every 7 years and is way above the target inflation rate around 2-3%. This combination of current yield and growth potential is what makes dividend investing so compelling. You're getting paid while you wait for the growth to compound. Let's talk about sustainability, because dividend growth means nothing if the dividends aren't sustainable. The payout ratio tells us what percentage of a company's earnings are being paid out as dividends. The results here are very encouraging. The growth stocks all have very conservative payout ratios. NVD at just 1%, ABEC at 10%, FOO at 16%, SPGI at 23%, and MSF at 24%. These low payout ratios indicate that these companies have enormous room to grow their dividends as their earnings grow. FB2AD has an 8% payout ratio, which makes sense given that Meta only recently started paying dividends. The dividend plays have higher but still reasonable payout ratios. UOB at 49.7% and DEVL at 56%. These are both in the moderate range and indicate sustainable dividend policies with room for growth. What this tells us is that every single dividend in this portfolio appears to be sustainable. The growth stocks are barely scratching the surface of their dividend potential, while the dividend plays are maintaining conservative policies that allow for continued growth. This is exactly what you want to see in a dividend growth portfolio. Current sustainability combined with future growth potential. First, this portfolio demonstrates that dividend investing isn't just about high current yields. By combining growth stocks with dividend plays, you can create a portfolio that balances current income with future growth potential. Second, the metrics we've analyzed, yield on cost, payout ratios, and growth rates, all point to a sustainable and growing income stream. The low payout ratios give me confidence that these dividends will continue to grow. Third, the strategy requires patience. A 1.05% current yield isn't exciting in the short term, but the long-term potential is significant. Dividend growth investing is about playing the long game. Fourth, diversification matters. By spreading across different sectors and geographies, I'm reducing the risk that any single company or sector derails the strategy. Is this strategy right for everyone? Probably not. If you need high current income today, a traditional high-yield dividend portfolio might be better. But if you're investing for the long term and can reinvest dividends, this growth-oriented approach could be very rewarding. What do you think? Does this strategy make sense to you? Are there any stocks you'd add or remove? Let me know in the comments below. If you found this analysis helpful, please like the video and subscribe for more dividend investing content. I'll be doing quarterly updates on this portfolio, so you can follow along with the results. Thanks for watching, and I'll see you in the next video.